Hey everyone, welcome back to Chipstock Investor.
Happy Friday, or if it's the weekend by the time you're seeing this, hope you're having a good weekend.
We're continuing our coverage of cheap stocks that have not run up with the market. So today we're going to be talking about Salesforce.
Oh, Salesforce. Yeah, doing a lot of work in the M&A space again, gearing up for agentic AI, and showing some signs of progress on both of those fronts. Maybe we should actually just start with the big acquisition that was announced in May and some of the subsequent actions since then, all gearing Salesforce up for a bigger push into this new AI eating SaaS era that we suddenly are finding ourselves in.
We'll start with this first one. Salesforce announced in May the acquisition of Informatica, and they're making that acquisition for around $8 billion in cash. Then let's take a look at a few more that they've announced. Bluebirds, that's one that is for sales teams and lead management. Y, a natural language to SQL database software, and Regrello, AI native automation company. All of these to bolster Salesforce's Agentforce and agentic AI or Slack business process automation capabilities.
Yeah, it seems that with AI, reportedly, at times anyways, depending on market sentiment, AI claiming to eat enterprise SaaS, well, Salesforce had to fire up the old merger and acquisition playbook that they retired during the bear market a couple of years ago. We think that's great news. This playbook became very unpopular among a lot of investors that had never owned Salesforce at any point in its history. But prior to the 2022 bear market, this worked very well for longtime CEO and founder of the company, Mark Benioff. We'll get to that at the very end, though. We'll show you the per share free cash flow profit.
Now let's take a look at the balance sheet highlights for Salesforce. We're going to show you a chart from our friends over at fiscal.ai. They're the sponsor of today's video, and we have a number of charts from them today.
Fiscal's been making some awesome upgrades to their research platform. Updated financials like this, available for charting and for analysis, are available within just a few minutes after a company reports its quarterly earnings.
If you want to analyze like us and make cool charts like this one, check out fiscal.ai/CSI, where you can get 15% off any paid plan, including their new enterprise plan for you pros out there. 15% off fiscal.ai/CSI. Even when that Informatica deal closes early in 2026 for $8 billion, Salesforce is going to still be net cash and investment positive over and above debt. Currently, in the last 12 months, they have over $20 billion total cash and long-term investments, $8.4 billion in debt.
And of course, this doesn't include any additional cash that will flow into the balance sheet over the course of the next 6 months or so ahead of that acquisition of Informatica. We think it's going to be a good one, but I think the reason everybody is probably wondering about Salesforce right now is what happened in Q2, because we had high hopes that the stock would rebound off of the very low valuation it's been trading for in recent months. And thus far, anyways, no dice. Here's the guidance that was provided a few months ago during Q1 of the new fiscal year.
Revenue was expected to be around 10.14 billion. GAAP earnings per share at the midpoint, $1.81. And then on a non-GAAP basis at the midpoint, $2.77.
Good news. The revenue beat expectations by just a little bit, maybe just about 100 million or just shy of 100 million. Important point here that I think we need to call out is we've circled here the 1.2 billion and plus of data cloud and AI annualized recurring revenue. Essentially, what this means is most of Salesforce's overall revenue growth in the last year, the majority of it has likely come from data cloud and some of these new AI initiatives, Agentforce, the agentic AI that Benioff has been pushing and talking up. And the rest of the business has kind of stalled out. Let's take a look at the breakdown of the different revenue segments. Platform and other, this is where a lot of those new AI acquisitions are going to get filed. The first line we have highlighted, you can see the nice little acceleration in growth quarter over quarter, and especially year over year. Q2 last year, 10% for platform and other. It's up to 16% this last quarter. So that's great. And then the other key segment, integration and analytics, that's disaggregated on the bottom three lines, MuleSoft, Tableau, and Slack. MuleSoft and Tableau, different data management software products. Slack, the workforce messaging and coordination platform. The acceleration in those businesses as well. And some of those agentic AI services will help with that. And so nice acceleration there. But the unhighlighted parts of the business, you can see indeed they have stalled out. Very, very little quarterly acceleration in sales, service, and marketing. Marketing actually down sequentially. Let's just kind of file that away as a concern and a reason why the stock probably shouldn't fetch a really, really high premium valuation anymore. Just kind of file that away and keep that in mind when you're thinking about investment decisions. Okay, let's continue with the quarterly results here.
We'll focus over on that right side of the chart in the capital returns. You can see 2.6 billion total capital return, 2.2 in share repurchases, and 399 million in dividends. What is a growth business? What does that mean? What are we looking for when we're investing in some of these companies, especially like a software company that's maturing? We need to see two levers, revenue and margin expansion. And so when those growth levers start to slow down, these capital returns especially become more important.
Yeah, and remember that second growth lever is often overlooked. A lot of investors stop at revenue growth, but the other growth lever is margin expansion. So let's talk about the margin expansion. Here's the earnings per share in the last quarter. We said the expectation was about $1.80 for GAAP earnings per share, $1.96. Okay, that's fantastic. They beat expectations there. On a non-GAAP basis, they were looking for $2.77, and they beat on an adjusted non-GAAP basis as well at $2.91. However, there is, it seems, going to be a quarter over quarter headwind to some of this margin expansion, especially on a GAAP basis. So they just did $1.96 on GAAP earnings per share in Q2, but the expectation in Q3 is just $1.60 to $1.62. That's obviously, Salesforce is GAAP profitable now. So that in the last couple of years has brought a bunch of new investors into the stock for the first time. But now we're taking a step back, at least temporarily. What's the reason for that?
Quote unquote, restructuring, firing people.
There were some long-winded comments from this on the earnings call. And Benioff reminded everybody that laying off underperforming employees is kind of a natural thing that happens every year, but obviously a little bit more than that taking place right now. And they're trying to streamline the business around these new AI products. And this makes sense because remember we called out and Salesforce themselves showed us a lot of the legacy databasing business around customer relationship management software has kind of stalled out. And so these new AI products and data cloud are the new push. And so you see the restructuring charges there highlighted in orange.
And we can imagine that there's going to be plenty more restructuring changes as they finish up these acquisitions.
Yeah, especially of Informatica. You'll see why Informatica is due for some restructuring here in just a moment. Guidance first.
It seems that maybe the market was looking for a bigger increase on revenue. The low end of guidance, they just increased $100 million. They expect 8.5 to 9% year over year growth in revenue, but they did increase significantly their operating cash flow growth and free cash flow growth. On the operating cash flow, they expected 10 to 11% year over year. Now they expect 12 to 13%. And then on free cash flow, the expectation was 9 to 10%. And now it's 12 to 13% year over year.
Yeah, and that's pretty good. So on this metric, on this profit metric, free cash flow, it is expected to grow more than revenue. So that growth driver, profit margin expansion, is still in play for Salesforce. So that's good. Even as the revenue has dipped and has stayed below 10%, it's good to see the profit margin expansion story is continuing.
And then based on that guidance, free cash flow should exit fiscal year 2026 around 14 billion, and their GAAP net income will gradually converge over time as Salesforce continues to mature. That acquisition of Informatica is definitely going to be the big story for Salesforce in calendar year 2026.
Yeah, we should hopefully see that close within the next 6 months. And let's see what that's going to do to Salesforce's business. So here's Informatica, annual revenue over the last 5 years or so. It kind of stalled out. This is going to be really important technology for Salesforce as they try to build up that data cloud. Informatica will become an important part of that data integration part of their business. But the revenue from Informatica has basically stagnated at best the last few years. Revenue, once that gets added to Salesforce, is approximately $41+ billion, about a 5% increase in revenue. And the free cash flow, only about a 3% free cash flow increase for Salesforce. So basically they're paying for $8 billion. What is that? Just shy of 20 times free cash flow. They're going to want to obviously get this synergized as quickly as they can to get the investment into this technology paid for as quickly as possible. But this should do the trick, at least for next year, accelerating Salesforce's revenue. Once Informatica gets added, they'll get that boost on a year-over-year basis, at least for a year. So that'll at least, maybe draw in some interest on the business for that reason. And then we would expect with Informatica's profitability basically minimal, that this should help fuel a further acceleration in profit margin expansion starting next year as well. We're optimistic about that deal for Salesforce. And as it pertains the valuation,
it's the lowest it's been in a very long time.
Yeah, I mean, it's like back on a free cash flow basis, especially back to where it was in the depths of the last bear market, 2022, 23. So is it cheap? I mean, it certainly could be cheap. Could be a pretty low bar for them to clear, especially with that pending purchase. Could be maybe not a totally transformational deal, but definitely a significant one. So let's look at one last metric here. On a free cash flow per share basis, Salesforce has done quite well, especially these last 3 years. They've made a great transition from a high growth business to a lower growth business that relies more on margin expansion to grow the business. We see this trend continuing. The metric has stalled out a little bit over the last 6 months, but some of the M&A activity and investments into the AI and Agentforce products likely the cause for that. It's going to take a little bit of time for the M&A machine. They're just now firing it back up. It's going to take a little bit of time for that to start to pay off. But you can see the long-term track record over 20 years. Salesforce's M&A playbook on a free cash flow per share basis, which will help account for any big increases in employee stock-based compensation and share count. Remember, this is per share. The M&A playbook was a good one, and we think it will work well this round for the business too.
Parts of this video were an excerpt from one of our live events that we hosted just recently. You can get access to that and all of our research with a Semiconductor Insider membership. Check out chipstockinvestor.com for that membership. See you over there.